The State Treasurer, Mr. Moore.
Here.
Director of Finance, Mr. McKay.
Here.
Ms. Hendricks.
Here.
Ms. Dillon.
Here.
Mr. Rosenstiel.
Here.
The State Superintendent of Public Instruction, Mr. Zeiger.
Here.
Mr. Unterman.
Here.
And for the State before, Mr. McGuire.
Here.
Mr. Keeley, you have a quorum.
Thank you. Item number 1 on the agenda is the approval of the committee agenda and work plan. I'd entertain a motion.
Move to approve. Second.
It's been moved by Ms. Hendrick, seconded by Ms. Dillon to approve the work plan. All those in favor?
Aye.
Opposed? Abstentions? Okay, that passes. We are now moving right into closed session. Just a couple of announcements and 2 little changes to the remainder of the agenda. Items 11 and 14, if it's okay with the committee, we'd like to move those down to after item 16. So let's move 11 and 14 to after 16, because we're not expecting, we're just going to be checking to see if there are questions of staff on those items. So 11 and 14 will be moved to after 16. And then just an announcement and a congratulations to Lamont King for his recent promotion to Attorney 4 and Lead Investment Counsel. Understand that was effective very recently. Congratulations. Okay, item 9, Chris, Chief Investment Officer's report.
Thank you. This is microphone. Thank you. Can you bring up the slides? There we go. That looks like me? Thank you. Nice guy. There we go. For the teachers in the back, in your newsletters, I am excited to say we hit $175 billion at October 31, so a significant update from the report that's in the book. You can see the asset mix there on the side, very close to all of our targets, and especially the new targets. So we're pretty much right on the mark. And the assets have grown substantially. We have a very nice positive return fiscal year to date. I don't want to repeat a number, but it is very strong, almost to what our target is. So part of me has wanted to just sell everything and go home for the rest of the fiscal year, but we're not going to do that. We're long-term investors. Here is a quick picture of the market so far in our current fiscal year. So what will surprise people is with all that talk about federal government shutting down and all of that, the stock market is up over 10%, the U.S. stock market, just since June 30. So that's just our current fiscal year, not the calendar year. And that's why we've done so well. So when you look at the market up over 2013, you can see that it's actually up 25% through October. The last couple of days in November have been up and down, but we're still... And look at that positive sloped trend line. It is just amazing over that time period. So I want to give people some perspective. So this is one of my famous charts. Yes, it's very busy. For the audience, I know you can't read it, but this is the annual return of the S&P 500 for the last 152 years. So the far end of the chart is the 1860s, Civil War. The middle of the chart, the big red lines that drop in the middle, that's the Depression. So the 1920s, so that, and 30s. So that kind of gives you some perspective of how long this chart is. The yellow line is the historical average return out of stocks. And what I wanted to do to draw some comparison is show you that's the year we're having right now, is up to about that yellow line. So a positive 25% year. It basically occurs about 1 every 7 years. Clearly, that's not a perfect historical average, but you can see that it's not common. It's not completely rare. You've had some years that are even much larger than that. But basically, think about, this is a very unusual year, 2013, without question. Who knows where we'll go in the next 60 days as we close year end. But it is going to rank itself in, one of about, I think it's 15, 16 years out of that 150-year period. where it is up that strong. So pretty remarkable. And then I wanted to talk a little bit about October 29th. Not a big deal for most people. I don't know if anybody watching might have their birthday on October 29th, but it is a rather significant day for CalSTRS in our investment history. So October 29th, 2007, we hit the all-time high intraday, single-day high of assets of $179 billion. What's really interesting to me is October 29th, 2013 is our fiscal year high this year, and the highest we've been since we were that level. And we hit $176 billion. So only about $3 billion below the all-time high. We can claim we've gotten back to our previous high because we've had a negative cash flow that entire period. In fact, our investment return is actually a positive 3% between those two data points. You know, if you started with, just say, $179 and 6 years later you ended with $176, you'd think you'd have a negative return, but we've been pulling money out of the ATM the whole time. So a quick comparison, back in 2007, yeah, Shrek 3 and what was it, Spider-Man 3, and I thought it was rather interesting. This year, Iron Man 3, but then it's Despicable number 2, I guess, or whatever that's called. So, but rather interesting. 2007, Boston Red Sox. 2013, Boston Red Sox. What do you know? We did hit a low. This is what's rather startling to me. We hit, after we peaked at $179 billion in 2007, less than 1 year later, we had dropped all the way down to $116.9 billion. But so that's pretty remarkable. From that low in 2008, we have climbed basically $60 billion over that time period. But again, from peak to peak, it is still a 3% return annualized over that time period. Far below the 7.5%, but kind of remarkable considering that peak and trough. So here's the wild ride. The peak in October of 2007, the drop in 2009. The stock market has fully recovered. It is back above that level. So here is the decline in the first half of the period, a 45% decline, and as we've talked about, you know, very quick and most of it in a few days. And then here has been the slow but steady climb back up. The thing that people don't realize is the stock market is up almost 200% with dividends. This is just price appreciation. But basically that annualizes to about almost a 25% return per year since 2009. So as we've discussed many times, not likely to recreate itself over and over in history. So it has been a remarkable V pattern. We're very cautious, particularly with the funding, on how we describe that, because we don't expect that remarkable recovery since the bottom in 2009 to continue. We're expecting a low return environment. So real quick, returns fiscal year to date. So through October 31, through Halloween, look at everything is in blue numbers, huge returns. Particularly I'd point out Australia and Germany, which people are quite surprised at, are some of the highest returning markets so far in dollar terms this fiscal year. And then, as we would expect, very low returns out of fixed income, about 1.4 and 1.7% coming out of the fixed income world. But just for 4 months of the fiscal year, we have already seen double-digit returns out of most of the world's equity markets. So really amazing year. The key events that lie ahead that we're looking at, obviously Janet Yellen's confirmation hearings the hearings haven't started, but the interviews have. Black Friday will actually matter because that really is a measure of consumer sentiment. Wall Street will look at that. We're going to have FOMC meetings, fourth quarter earnings, and then, of course, the last two are the big ones, which are going to be the federal budget deficit on January 15, and then the debt ceiling limit that will appear on Feb 4. So if you enjoyed the excitement of September and early October, good news, it'll come back. And we'll relive it again in early January, February, hopefully with not all the same rigmarole, because we certainly got sick of it. Yes, sir.
Ms. Dillon has a question.
So, from my understanding, listening to the radio and stuff like that, Black Friday is no longer Black Friday because Thanksgiving's so late.
Yes.
major corporations, big businesses are trying to capitalize on the short time. So now it's going to be 2 days. Has there been any talk about the effect that that's going to have?
No,
2 days
Wall
instead of
Street.
one?
Yeah, Wall Street is more. It messes up the same store sales and all the comparisons. And obviously, you've seen the ads. People are starting layaways and sales, and particularly J.C. Penney, that is so crippled as a company, is already doing doorbusters starting tomorrow. So there's an ad for them. Everybody get up early, and go buy their lousy goods. No comment. Hey, half my shirt in my wardrobe is from J.C. Penney. It'll affect consumer sentiment. I think that's what they want to gauge is with the government shutdown, with the economy where it's at. We know the unemployment and the unemployed people. Will there still be a heavy Christmas season? Because retail, as we all know, demands heavily on that time period. I can't even imagine the amount of sales tax that occurs in California in that 2-week period. And then you're going to still have, as my staff pointed out, Cyber Monday. You're going to still have the effect. That's not going to be Cyber Monday anymore because that was all driven by internet access. And now we all have plenty of bandwidth. And so we don't have to come to work to buy goods. You can buy it on your phone driving to somewhere, but not while you're driving, right?
Don't look at me for help.
I'm burying myself out here. So the answer is, I think they're just going to gauge all the numbers and try and get a feeling. Consumers still drive 70% of the U.S. economy. You just can't let go of that fact. So consumer sentiment matters, and it's how they feel, but then how they act.
All right, thanks.
You bet. Next minefield I'll step into is going up in the crow's nest and looking out, and my animation is not rolling here, so here we go. So the same kind of stuff we said is on the list as it was before. When I look at Europe, I'm still definitely worried about Italy. That has not made the headlines, and they have solved it to some extent. But the market does feel tired. I think to us, we're worried about going into the holiday season and then mostly into January with all that going on, what might happen. And then we're going to have to deal with the fact that we're at, historically low interest rates. So most of those have stayed the same. The one positive is now we know who the next Fed chairman is, somebody with some California experience, and the first woman to run the central bank. So that's hopefully, that is very exciting. The awards. First off, I wanted to mention to the audience, AICIO does a magazine. It's Asset International Chief Investment Officer magazine. They list out a Power 100. We've gotten ranked every year. This year, they moved me and CalSTRS all the way up to third. So we're the first U.S. fund listed, and thanks.
Of yourself though, like sketch.
That's
the
terrible.
interview.
That's just awful. It looks that's terrible. But it was neat to see because it really it's third in the world, and we're the first U.S. fund listed. And then Dana, I didn't tell you, but I put up there on your desk. If you could, Dana received this beautiful award from the Asian American Association of Investment Managers, and it is their Challenge Award. What was it? I'm trying to read from here. The name.
Champions Award.
Champions Award, and that was recently, Dana received that on our behalf at a recent event, and we got a nice resolution from the controller's office, which we're going to mount. So, and then the last positive thing, which we haven't had a chance to publicly announce, we just found out this week, Pension and Investment Magazine, Randy, who's back there, sitting there, they do a survey. This is the second year they've done a survey of where are the best places to work in the investment management industry. And I am thrilled to say we found out that the investment office was selected. We are the first pension plan government entity ever mentioned. Before that, it's always been money managers. So we are going to be one of 15 institutions listed as the best places to work in the money management industry in 2013. So we're pretty psyched about that. We're definitely going to use that in our recruiting, and they'll do an article. We'll probably, he said, probably appear December or somewhere in January with an article about us and interviews with the staff. So really positive. Any questions?
Seeing none, thank you very much, Chris. Item 10 is the approval of the minutes from September 10th, 2013. It's consent. Does anybody, any questions about the minutes? Seeing none, all those in favor?
Aye.
Opposed? Okay, thank you. We are skipping, we're going to move 11 to the end of the agenda. Number 12, item 12, annual CEM investment cost report. Ms. Smith.
Good afternoon.
Hi.
Hi,
Hi, Deborah.
Deborah Smith, Investment Operations Director. I'd like to introduce Melissa Duranco. She's an investment officer on my operations leadership team. She does a lot of stuff for me, but one of the important things that she does is gathers and analyzes data for the cost-effective measurement, or CEM, survey. I also have with me Jody McIntosh. Jody is a director of CEM, and she's also a chief financial analyst. She came all the way here from Canada, so we appreciate that. The purpose of the item is to provide you insight as to how we effectively manage the investment branch and the cost compared to our U.S. peers. Costs are a constant drag on our portfolios, so we manage them very closely. We provide a ton of data to CEM for them to produce their cost-effective report. We have to take our fiscal year data and convert it into calendar year data because that's how CEM wants to receive the information. Some of the data elements, for example, I'll take global equity, for example. CEM will ask us in our survey, how much are we invested in U.S. versus non-U.S.? Passive management versus active management. How much do we have internally managed versus externally managed? They'll also ask us about our management fee cost. So we give them that information and they put that in their database and they compare us to our global peers and our US peers. And this gives us an idea of if we're negotiating our management fees effectively.
I'm sorry to interrupt.
Yes.
Committee member that has a question
Sure.
right now.
I'm just trying, just to level set, understanding what's included in this cost data as opposed to what flows through the financial statements as investment cost?
So this data is basically all of the investment costs related to performing our services. So any type of technology, any type of risk systems, the operating salaries of the investment branch, anything that we need, any tools or resources we need to manage the investment portfolio.
With the organizational indirectly in there too, the HR and all this support, it's the whole organization contribution here too, isn't it? Side investments.
Yeah.
That's correct.
And those would all flow through this,
Yeah, they're all the same.
income statement. But then you have management fees which don't.
So on the
Brokerage
financial-
fees or dealer fees when you trade that don't. I'm just trying to get a sense of.
So this report is isolating just the cost to run the investment part of the balance sheet. The biggest difference between their methodology and GAAP and the financial statements is they try and quantify the cost of real estate and private equity, the management fees, and the carried interest. It's not an exact science. There's been lots of discrepancies. I think what I told Jody, it's what we're hearing from our CEIO peers around the world, is no one can agree, but CEMs we're finding is kind of at least a common ground. It's not our favorite. We wish it was better, but or I should say it's the one we're all agreeing to, even though we think it could be better. So they're trying to capture the total cost to run the plan. But generally, everything that's gap is all in the financial statements that Robin does.
Right. But capitalized items wouldn't.
Yeah, you have a good point. The commission costs, things like that, they're all netted.
Right.
So they wouldn't show up in your income statement. There are some things that show up as net returns.
Yeah,
They're
yeah.
trying to break them out and capture.
And they capture that.
Yeah.
Okay.
Did you wanna?
Yes, as Chris said, currently, we're not capturing all costs, as you pointed out, especially on the private assets, so performance fees. There's a lot of other costs like transaction fees, et cetera. Why we're not reporting on that presently is because we cannot get consistent data from our clients. In turn, our clients have trouble getting accurate fee data from their managers. So as a compromise, what we're doing right now is we report base management fees for the private assets. We did roll out a new service 3 years ago, Global Leaders, which is targeted at our largest funds around the globe. CalSTRS is currently participating. And what we're doing with that service is each year we're going to delve into issues that pertain to these large complex funds with the hopes of finding better solutions. And one of the issues that we're trying to address this year is exactly that, the costs on the private market side. So what we're doing today is not perfect, but we are working towards getting to a better solution.
With that, I'll hand it over to Jody,
Thank you.
and she'll present the 2012 calendar year investment branch results.
Thank you for the opportunity to present to you today. For those of you who are not familiar with CEM, it stands for Cost Effectiveness Measurement. We benchmark pension funds around the globe on performance and cost, with our main focus being on the cost side. Our motto is what gets measured gets managed. And for the past 20 years, we've been looking at the relationship between what funds pay in terms of cost and the performance. And to date, we haven't found any relationship. So funds that are paying more are not necessarily getting more in terms of performance or value add. So therefore, we believe that costs are important and they should be managed. And I think you'll see from my presentation that CalSTRS is doing an excellent job at managing its costs. This slide is showing you a snapshot of our global database. So we benchmark just over $6 trillion in assets. Of course, for your fund being based in the U.S., we look at the U.S. universe, of which there's currently 184 funds with just over $3 trillion in assets. On the cost side, we put together a custom peer group to benchmark you against. The peer group is based on fund size because, of course, size is going to have a huge impact on the costs that you pay. Your peer group is comprised of 15 U.S. public sponsors from 38 to 249 billion. You're at 158 billion versus the median at 65. So you are the second bar from the far right. Just before looking at the cost side, we take a quick look at your asset mix versus your peer group in 2012. You can see your fund is just slightly higher on total stock, 53% versus 49%. I'll point out, you'll see your peers have other stock of 18%. Those include global and all country ex-US mandates. On the fixed income side, you're just slightly lower, 22% versus 25%. And then if we look at alternative assets, you're not in hedge funds versus your peers at 3%. You're somewhat higher in real estate, 12% versus 9%. So I'm now turning to the cost side, and this is looking at calendar year 2012. Total costs reported were just over 714 million, or 47 basis points. This table breaks the fees out. The upper portion are the investment management fees, just over 703 million. And the bottom portion is oversight, custodial, and other at just over 11.6 million. This is showing your cost trend over the past 5 years. You'll see that your costs have come down slightly since 2008, which is quite unusual. For the most part, we're seeing costs going up at funds, not coming down. So this is good news, and especially if you look at public assets. In 2010, it was at 11.9 basis points, and it's now down to 9.4.
If I could jump in, just for the board's sake, that really is a reflection of the global equity team and the fixed income team growing aggressively starting in '08 to ask managers to renegotiate their fees lower. And as we've reported to you, they achieved on average a 10% reduction in the investment management costs in that area.
On this next slide, this is looking at your total cost of 47.2 versus the peer and U.S. universe. Of course, the peer group is the most relevant measure, and you can see that you're far below the peer average of 60.7, and you're only at the 25th percentile. So again, very strong results. Here, we're looking at your costs on a slightly different way. We're comparing you to a benchmark cost. To calculate the benchmark cost, we take your asset mix and we substitute in what your peers pay in each of the asset classes. So it's as if, say, CalSTRS and some of your other peers had your asset mix. What would they be paying? So the benchmark cost tells us they would be paying 56.8. So you were low cost by 9.5. And I'm going to, on the next few slides, break that amount out for you.
And so just so the board can relate, that's basically 10 basis points lower on the 175 billion per year, year in and year out.
Yeah.
Which I should have multiplied out, but that is real money in our case.
So here we're showing how the 9.5 is split out. If we look at your implementation style, and by that we mean whether you're using internal or external management or active or passive, that is adding 4.8 basis points. And if we look at what you pay for similar services, so what you actually pay for internal and external management as well as oversight, you're saving, very high savings there, 14.3 basis points. If we
Before you
focus-
continue, Ms. McIntosh, there's a question
Okay.
from Ms. Hendricks.
So I just had a question on that last slide, if you could go back to it. So the first one, does that mean that we have a higher cost when you were talking about the active versus passive, you're saying that we have a higher cost implementation style? The CalSTRS?
Yes, and you'll see on the next two slides, I'm going to explain that.
Okay,
Yeah.
okay.
Okay.
If you're gonna explain it, then I'll.
So this slide is focusing just on implementation style, and we look at the four styles in the chart, so internal, passive, and active, as well as external, passive, and active. External active tends to be the most expensive. You're using less of that, 50% versus the peers at 57%. We also look at what you have in fund of funds because they are by far the most expensive investment style. You don't have anything in fund of funds versus your peers that have 10% of alternative assets. And this is quantified on the following page. Lots of numbers here, but I will point you to the more pertinent numbers. So the implementation style actually added 4.8 basis points. What this table is doing is by asset class, it's looking at the amount of external active management you use relative to your peers. And if you look at the far right column, you can see where you're paying more and in some cases paying less. The biggest cost item I'll draw your attention to is halfway down the page, real estate ex REITs. And if you look below that, of which limited partnerships represent, you're at 49.7 versus the peer group at 32.5. So that's causing an additional cost of just over 39 million. So that's what's really driving the additional cost on the implementation side. Having said that, you'll see on the next page that what you actually pay for the real estate limited partnerships is lower than your peers. So you're actually making up that. And again, you'll see that on, excuse me, on the next page. We add to that, you'll see at the bottom of the page, the fact that you're using somewhat a higher level of overlays than your peers added 2.4 basis points. So now I'm moving away from implementation and looking at what did you pay for external investment management. Significant savings here of 11.7 basis points or 177 million. And in terms of what's driving that, if you look at stock emerging active, the far right column, savings of 10.8 million. And if you look further down to the alternatives, so real estate ex-REITs active, savings of 15 million. This is what I mentioned earlier, the real estate ex-REITs limited partnership savings of over 71 million. And likewise with the diversified private equity and LBO active, so very strong savings. This next slide, similar to the last one, but it's looking at internal investment management. Again, savings here of 32 million. And the key savings is coming from the bottom line, the derivatives, currency discretionary. So you're much lower cost than your peers for a savings of 29 million. This is looking at oversight, custodial, and other costs. And again, savings here, most notably the oversight, consulting, and performance measurement line, close to $10 million in savings versus your peers.
And Jody, if I can jump in, before our consultants, you've noticed I've moved them up, so they're sitting all over there. That's going to be their permanent seat based on your feedback from the offsite, so they can also go forward, which they're supposed to do. I'm going to put little electric buzzers in those chairs so we can get them to come up. But before they all start to want to renegotiate their contracts,
Electric buzzers. In their
yeah,
chairs.
well, you do, as you know, in 30 days, you're going to be interviewing for general consultants again and looking at fees. But what has always struck me here, even though we employ a lot of consultants, and I know we talk about that a lot, we're actually significantly about a quarter of the cost of our peers in the cost that we pay for consultant services. So it's a lot of money because of our size, but it's rather remarkable, maybe on the flip side, that our peers pay so much more than we do. But that is a good way for us to be able to monitor that, the custodian fee, the audit fee, all those kinds of things. What are we paying for the same services? That's why we like this service, is it allows a little more apples to apples comparisons on costs.
And finally, just to summarize, so if we look at your implementation style, by not using fund to funds, you saved 0.5 basis points. Your use of external management added 3.1, and that's mainly your higher use of real estate limited partnerships. And your higher use of overlays added 2.4. You more than offset that by what you paid for external investment management savings of 11.7, internal savings of 2.1, and oversight, custodial, and other savings of 0.5. So those are all my comments, unless there's any questions.
Questions or comments from the committee?
Good job.
Okay, seeing none? Okay,
Thank you.
thank you very much. Item 13, global equity active versus passive U.S. management.
As the team comes up, this is basically step 2, but it's one step toward the finals of the active-passive study. If you recall back in March or April, Alan Emkin questioned the value of active management. We did a very thorough panel in June. Just due to the timing and the breaks and obviously the change in staff, we are bringing the second phase to you now, and they want to kind of walk you through their thought process, our history, and then in their example, they gave you some examples of different allocations to active management. We're staff at the end. I won't steal their thunder, which they're looking at me. I always do. David bet me I would. they're going to conclude with where staff is leaning as a recommendation. On the plan, we'd come back in February anyway with the global equity investment policy, and this would be the chance for you to tell us if you want to make changes to that beyond our recommendations. So with that, I'll turn it over to David Murphy, our Acting Director of Global Equity.
Thank you, Chris. Good afternoon, everybody. David Murphy, Acting Director, Global Equity. I'd like to introduce the team. Start with Arinthio Swanigan. He started with Global Equity back in 2008. And then Helena Kalesha, she started in 2010. And then we have our newest hire that started 3 weeks ago, Candace Ronan. So this is the team. Before we get started with the item, I wanted to point out one correction. It's an INV 303. In the middle of the page, there's a December 31st, 2013. That should be 2012. Right under history of the item. Okay, good. It's been fixed. At the April 2013 meeting, the investment committee asked us to do a research of active management in the U.S. equity portfolio. And if you guys remember, we had the first part of this review back in June, where David Castillo gave I thought he did a phenomenal job on the panel debate with some of our investment managers. I hope everybody had a chance to see that. And this is part 2 of the review. And this is where we're going to be talking about the history of the U.S. equity portfolio, also talk about our peer comparison, and then talk about different active allocations and their potential impact to the portfolio. So really, why are we here? And this slide explains it all. And really, this performance begs the question, does U.S. active management still add value? This is how the performance looked as of December 31st, 2012. The 1-year performance, we were down 156 basis points. The 3 and the 5-year, we were down, a few basis points, but it was negative. And then the 10-year, we were barely positive at 17 basis points.
And David, I'd add, this is, for the board, this was the slide, not this slide, but the information Alan was presenting in April of the year when he made the comment about you got to look at active management again.
Correct. So we're going to fast forward 9 months. Where are we now? So if you look at the next slide, this is what's happened since then. So as of September 30th, 2013, active management is up 251 basis points. The 3 and the 5-year has gone positive over 30 basis points each. And then the 10-year net annualized alpha is at 35 basis points. So it's really, when you look at it, it really shows a different picture.
Those are net of fees?
These are all net of fees. Correct.
Sorry, David.
Oh, please, go ahead.
I warned you I'd jump in. If you can go back the slide. And this one says it too, but what you'll constantly hear from us about performance is that time period matters. And this is a classic example of like the 1 year ending December versus 1 year ending September. That 12-month period, dramatically different picture.
There's 9 months, yeah.
It's just amazing.
So going on to the next slide, this is showing the breakdown of annual performance of the U.S. active portfolio going back to 1999. And you can see there's quite a bit of volatility, and there's a pretty big range. If you look at 2002, the portfolio outperformed by 339 basis points. But then you see our worst year in 2007, the portfolio lagged by 175 basis points. But if you look over this whole span, 12 out of the 15 years, it was positive, and it's 80% of the time that it's outperforming. That's a pretty good percentage. When we talk to our investment managers, we don't really talk about the year-to-year changes. What really matters to us is like the 3 to 5 year performance. We want them to be generating net alpha over that period. So when we're evaluating our program, we'd like to look at the longer periods. And this is what this is showing is the 10-year net excess return of the U.S. active portfolio. Back in 2008, it was 100 basis points, which, is absolutely huge. And I don't think our expectations should be that high. You can see that it's trailed down a little bit, 9, 10, and 11, and it had a drop-off in 2012 where it was positive 17 basis points. But as of September 30th, we had a pop back up to 35 basis points of the net annualized alpha. And to put this in dollar terms, the cumulative excess return was more than $650 million over the last 10 years. That's a significant amount of money that could pay quite a bit of benefits. So with that, I'm going to hand it off to Arinthio to talk about the history.
Great, thank you, David. And good afternoon, everyone. Before I dive into the timeline, just want to note that dating back to the inception of the U.S. equity portfolio, staff has typically reevaluated the active and passive policy targets roughly twice a decade. So we're about due. And then just to briefly walk you through the timeline, looking at 1986, that's when CalSTRS established its first investment policy and management plan, which set the active and passive policy targets at 20% and 80% respectively. Fast forward to 2003, the policy targets remained intact until that point when they were modified to 30% and 70% respectively with a range of plus or minus 5%. The most recent change occurred in 2010, in which the policy targets remained intact. However, the range was modified to plus or minus 10%. And then a couple of other obvious highlights on the timeline are 2004, in which both our corporate governance as well as our developing manager programs were implemented. And then 2007, you can see that our sustainable investment manager program was also established. So with that, Helena's will walk us through our peer comparison.
Thank you. From looking at this slide, you can see how a lot of our peers are positioned as of June 30th. And from this, you can tell there's clearly no consensus view. You have a 12% active allocation at the New York State Common Retirement Fund to a 100% active allocation at the New Jersey Division of Investments. So clearly, CalSTRS is not an outlier. We're actually towards the lower end of that range at 35%. Additionally, for comparative purposes, according to the 2012 CEM survey, which has a custom index of 15 U.S. pension funds ranging anywhere in size from $38 billion to $249 billion, they allocated approximately 35% to active management, which puts CalSTRS essentially right in line with its peers. Thank you.
Got to turn it on. This next slide, what staff did, we created a matrix which contains some factors to consider when exploring the possibility of changing the active allocation targets. I mean, some of these factors are really obvious, others are not so much obvious. The first one, alpha potential. At a 30% active allocation, it really has a moderate impact on the overall U.S. equity portfolio. But as you reduce the active management, you'll see that the alpha potential goes down, and it makes sense. And the same thing with forecast tracking error. As you reduce the active allocation, the tracking error goes down. But a couple areas that I really wanted to highlight was the potential impact to the special programs. And the special programs are what Arinthia was talking about earlier. This is the corporate governance, developing manager, and sustainable investment programs. If we reduce the active management, we'd have to make some tough decisions. Do we also want to reduce these particular programs? Another thing that's really not that obvious is the potential impact to the market insight and research that we get from our external managers, because they're really an extension of staff. They provide valuable market information. They perform ad hoc research for us. And just recently at the last TAC meeting that Chris mentioned, we talked with a cross-section of our managers to ask them about the upcoming debt ceiling and debt debate, what they think is the potential impact, how would they position the portfolio. And it's a really good dialogue to have with some of the brightest people on Wall Street. And then the last factor is the management fees. As you reduce the active percentage, the management fees do go down. But it really depends on what programs you choose. The core program, which are the traditional bottom-up stock pickers, their fees are much lower than some of the developing manager or corporate governance funds. So depending on what you choose will be the impact of the management fee reduction. So moving on to the conclusion, I've talked to so many people about the active passive, and nobody agrees on what should be the absolute allocation in our U.S. active portfolio. I think Mr. Rosenstiel asked a panel of experts, and I think he might have had a different answer from each one of them, an 80-20, 70-30. Everybody's going to have a different idea. But from our experience, we have been successful in active management over the long run. There's some volatility year to year, but if you look at the longer track record, it's been positive. But we recognize it's not easy, and it's going to be a challenge to generate alpha in the future. Based on this review, investment staff believes that the current 30% target that we have right now with the flexibility of being plus or minus 10% is appropriate for the U.S. equity portfolio at this time. And as Chris mentioned before, our policy is going to be presented to the board in February 2014, and this is mainly to make modifications to the portfolio to support internal management. But if that time you'd want to make a change to the active allocation, we can discuss it then. So with that, if the board has any questions, we'd be happy to answer them.
Thanks. Thank you very much, Mr. Murphy. Ms. Hendricks?
I was just curious, David, when your closing comments, I mean, what factors should we be considering to decide if 35% is appropriate, or as we look at it for next year, what are the factors we should be considering in terms of changing our allocation or?
The factors that I had on this slide here. I mean, to me, we thought these were like probably the top 5 factors to look at. And, the first 2 I think are pretty obvious. The less active management we have, the less alpha potential, the more we're going to be just like the benchmark. So if the markets are going really strong up, a lot of times active management trails in that type of environment, but when there's a correction, active management tends to do better. Can't generalize, but tends to do better. And we also need to think about special programs. Would we want to make a reduction, kind of like a pro rata cut across all the programs we have, corporate governance, developing manager, sustainable, or is it just from the core fundamental managers? I don't know if that answers your question.
It does.
Sharon, if I were a board member, and I've had to go through this exercise at a couple of funds, we go through it because we have to come up with a recommendation to you. It has to really do with your level of confidence in active management. Right. And I think as we've debated, it's not clear cut. Public pension plans, we've debated active passive here at CalSTRS. This is the 3rd time, as Orinthio said, 3rd time in basically a decade. So there's no clear answer. It is, as you'll hear me say, investments is more art than science. I point out lots of times almost everybody has a Bachelor of Arts degree, very few Bachelors of Sciences. So it is an art. This is where it is sort of a judgment call. The fact that we have the specialty programs of corporate governance and the diversity managers, we've got to factor that in. We were 80-20 for a long time, and the reality is throughout most of the 90s, we were almost 90 to 95% passive. The staff would fire, the CIO at the time would fire managers and then not replace them. So even though the policy was 80-20, we were almost totally passive. We inched back up the active management because we thought we could improve the procurement process on how we hire them. Jack's now given us what we call the alternative solicitation process, the ASP, and we think that, along with our specialty programs, gives us a better chance at making alpha. But as David's slide showed you, there's still going to be periods where we stink or our managers stink. From our perspective, when we came in and made the decision, should we be at 70%? Should we, we don't think we should be at 0. And I had a fund that did that. The board just said, forget it, we're tired of hiring these people. But I think they had and they acknowledged they had a flawed process about how they hired managers. We came back with a view, we like the specialty programs, we think they can add value over the long term, so we are coming back to recommend we stay at 30. 30 versus 35 versus 25, that really is a very tight judgment call. It's tough to be that fine within active management. And David, I wanted to point, just so on the record, we're recommending we stay at 30%. Stay at 30. And I think it's important to point out, Neil, if you want to come up and correct us, but PCA is now is in concurrence with that. They're recommending that we stay at 30% active.
Does that mean 30-ish?
The question was from the board, does that mean 30-ish? What are you recommending, Neil? Come on
The
up.
hand waving.
Neil Rube, come forward.
I need more definitive.
We're going to tell him you said that.
I'm going to take that on video with my iPhone.
That's okay. If you go to like INV, I think it's 304, the calendar year. Just a couple of quick comments. The history on the 30%, it was 20 for a while, as Chris mentioned, but that we just didn't feel that was high enough to move the dial to get the contribution out of active management. If you're confident in it, you want to take some form of a material allocation to it. So 30% was sort of that minimum material level after a lot of discussion back in time, 10 years ago or so. If you go to the calendar year chart up on the, if you can just bring that up, I don't know if if you're looking at your CalSTRS staff as an investment manager that you want to be confident in, this is sort of the first place to go, in the sense that CalSTRS, like David mentioned, has been able to outperform, in the U.S. equity space only, been able to outperform the benchmark 80% of the time. If you've listened to the active managers, their hit rate in terms of success is somewhere between 55 and 60%. So an 80%, 80% of the years going back in a pretty far distance is a very commendable record. It does not guarantee that you can do this again, but how long has STRS's existing process and team been in place? I would say it's gone back at least an investment cycle, where the structure that's been in place and the process of reviewing managers and the new RFP process, et cetera, that's been operating pretty consistently for maybe 1 or 2 investment cycles now. So those are just summary comments to indicate that STRS has put together a good track record. They have a good proven policy and process that really hasn't changed. Significantly, maybe at the margins it has, but significantly it's been the same process. So I'd recommend just holding it at the 30%. Happy to answer any other questions.
Good job for the chair.
Thanks, Dave.
Any other questions? Mr. McGuire?
You can have, this isn't addressing internal versus external, though, at all.
This is not addressing that.
And is that going to be a separate discussion, or is that just up to the discretion of the staff, or what?
That will be a separate discussion, talking about bringing more internal strategy in, because that is the long-term goal.
What is it right now that is, what percentage of that, or of that 35% or 30% or
For the
whatever we
active?
have right now, what portion is
For the
active
active, it's
in-house?
0 internally managed.
0 internal?
It's
The
all
only-
external.
The only equity internal
Correct.
is passive, and it's U.S. internal. And the active
Right.
passive is something we looked at. We have the 3 stages. Michelle will keep reporting it to you. We're in the
I thought
no. middle of
that was the
stage
case.
2.
I just wanted to confirm,
Yeah.
because I
No,
get
this is just active management, which is all
things
external.
mixed up between 2 funds and so on.
Any questions? Comments? Okay, thank you very much.
Thank you.
Good job, Dave. Very nice work.